Good evening, ladies and gentlemen. Thank you all for tuning into my video. Today I'll basically be doing an analysis about the S&P 500 as well as the Volatility Index and how you guys can use that to currently gauge the market environment and possibly anticipate where we could be heading into the very near short-term future. But before I kick things off, I just want to put a legal disclaimer. I am not a financial advisor. I've got no formal education within the financial industry. I've just basically taken my self-education within my own hands. I've spent 18 hours a day watching the screens, and I'd simply like to share my findings with you all. I'll also like to say that, it's not very often that I put out videos, so it is a little bit out of my comfort zone. Forgive me if my voice sounds a little bit weird. If I make mistakes, I'm pretty natural, so I'll kick things off that way. Yeah, guys, so as you can see, this is my trading platform with CMC Markets. It's got the ANZ branding, but it's pretty rubbish. I'll get into that a little bit later on, but for the purpose of this video, I'd like to keep it under 20 minutes if possible. And let's just use good old TradingView to analyze the S&P 500. Now, most people may be aware, I hope they're aware, that we've recently been reversing quite a bit of the recent highs within the S&P 500. Now, some people prefer to analyze the Dow Jones. That's, I guess that's fine. It's all within personal preference. With me, however, I place more preference to the S&P 500. The reason for that is they contain the 500 best companies within America. So I use that as my gauge. The Dow Jones also moves in synchrony with the S&P 500, so no big deal there. But what I wanted to really discuss, which I don't think I have heard many analysts discuss this before, the market is definitely in cycles. Most people do know that the bull markets last about 10 years. When the markets reverse, they generally last 6 months to 1.6 months, or 1.5 years basically, in bear months. So we've been overdue now for quite some time. There's a lot of, media coming out, people trying to basically put fear into the marketplace. They're trying to call a correction. Now, let me just quickly chuck up a 200-day moving average. Now, me personally, I don't have too much indicators on my chart. I like to keep things very clean, very neat. But I know that a lot of people, especially investors, they use the 200-day moving average as a last line of defense for their investments. If a stock does drop below that line, things can get nasty. So I guess the point is, when there's so many people using a particular moving average, they tend to become a self-fulfilling prophecy. What I mean by that is, just in the recent example, back in the February crash, the S&P 500 bounced clearly off the 200-day moving average, not just once, but twice, 3 times, and a failed 4th attempt. Okay, so before I really get too far ahead of myself, I'll explain a little bit about the moving average. The fact that it's in an uptrend and that it's going up signifies that we are in an uptrend. Now, what a lot of investors will be looking for within the 200-day moving average is this little drop in the curve. So as you can see, it was running straight up, but as of recently, we flatlined. We went straight, followed by a very recent dip. I'm not sure if that can be seen properly. But it is slightly starting to dip down with big volume. So the market clearly sees that maybe the trend may change. But I also want to pay particular reference to the fact that the Dow or the S&P is pretty close to a double top. So technically, yes, it is a technical breakout. The former high was 286.63. The fact that we have broken out is a technical breakout. But let's have a look here, a little bit closer. Let me just draw the line so everyone can see what I'm doing as I'm going along. As people can see, I haven't signed into this. I don't have a platform. What am I doing? I'm doing a support line, so horizontal. Okay, perfect. Now what we can see is it broke out, retested the former highs, retested the highs for some support. It managed to catch some support and yet broke out again from the 291 highs. But look where it got stuffed. By 293, 294 it topped out. For me, that's a very, very weak breakout. And it's also evident by the fact that it broke below the former high back in January. We've continued to reverse to the downside and we're currently below the 200-day moving average. Now, here's where technical analysis can have some weight. You don't need to wait for the 200-day moving average to go below. I see this as pretty much a double top, especially this section here. If it wasn't such a weak breakout, I would also consider it as a double top at 286. So here's the next part into the thesis. Okay, we've had our bull run for what, 10 years, right? 2015, these were a little bit of crashes that happened in America, which also affected our markets. Now, since then, we haven't had a proper correction. But what's very noticeable is a big uptrend, followed by a big shake, bounced really well, tested the 200, but we've got a weak breakout and yet again, we're back below the 200-day moving average. So I believe... okay, 1 second. Yeah, sorry guys, I just had my little brother walk into the room, so I got distracted. But where were we? I get distracted pretty easily, sorry about that guys. Yeah, so the main message that I'm trying to bring about is the entire market has been sniffing weakness. We've had a correction back in January, and we've got another correction again now. There hasn't been so much recent volatility lately within this index. Okay, so let's say, for example, we do lose the support here at the 200s, 258s. With a bear market retracement, they tend to reverse by 50%. So let's just use the current level and see what 50% may look like. Around what, 130? Well, I don't even know how to work that out from here. What would be 50% of that? My math is so bad, but from technical levels, you've got support back at the $213 ranges. So we could test this whole entire zone. The market makers may possibly see if this will be a quadruple bottom here at 180. If 200 doesn't hold, if these levels here don't hold, guaranteed we're going to retest these 180 levels. And you know, that's a big drop from 265 down to 180. I don't know the exact math. There's a way I can figure it out. Yep, here we go. Let's say we do test those highs. We're looking at an 18% drop. Well, if that's an 18% drop, it's got a lot more lower to go if that's the case. But okay, let's now do a little bit of analysis on the volatility index. This is something that was taught to me by a couple of people within the industry. So these are people that work as portfolio managers, as hedge fund managers, as proprietary traders on a floor where they do trades. You know, we all know what a prop trader is. Yeah, so a gentleman in particular that has taught me this is a guy by the name of Terry Tran. You guys can check him up on Google. He's very well documented. He's spent 6+ years working inside of a bank. He's got a hedge fund experience. He's, you know, been a portfolio manager and also works as a private trader for his family and friends, doing proprietary trading and whatnot. So what they do is they use the volatility index to get a scope of what the overall market conditions are doing. Now, if there's anything that I'm going to be sharing, I think this could be one of the most critical components. What was shared with me is hedge fund managers and portfolio managers look at key levels such as, let me go as high as 30. Now what 30, the level 30 signifies do not trade or do not invest. Like it's basically the red lights when it hits the level 30. When it hits around 20 to 25, they exercise caution. When it's below 15, which we've been on a historical level for quite some time, then it's basically okay. It's not too much risk. Now, if we go through a longer analysis of this, let me actually use a weekly chart. Okay, now 2008 was obviously the GFC. I've got actually a photo of this saved on my computer somewhere. I wish I had that instead. But next to these certain areas, I ended up putting what events took place at that time and why the volatility went that spastic. But if we would go back into 2008, this was the GFC. And we can see that from 2008 to 2010, for almost 2 years we were suffering. Oh, sorry, yeah, we didn't even suffer for that long. It went back down. After 2 years, we had another spike. So I'm not sure if that was Brexit, but some world events happened during these periods of volatility. And as we can see, the markets have always recovered. But what I really want to pay attention to is all this recent volatility we've been having. This is because we've been running for 10 years, and I believe we're due for a correction very, very soon. Like I said, we're in the 20 to 25 limit range, meaning it's amber, exercise a little bit of caution. With this clear pattern, this is a weekly trend, and we can see that it's making lower highs, lower lows. What the hell am I on about? It's making higher lows. I always get this confused. It's making higher lows, and it's forming a little bit of a pennant formation here. I mean, it wants to go into the 30s, guys. This is very evident to see. It wants to go into the 30s. We've had recent volatility. And let me compare this with the S&P 500. This is where things get interesting. Well, I'm anticipating things would be getting interesting. I've never really done this before. S&P. I'll just go SPY. Okay, so here's what this is saying. Well, I can't move that. Okay, fair enough. Well, like I said, this is a weekly chart still. The 200-day has been moving up. We've had big volatility in spikes. There we go, that's a bit more better. And we're now above the 200 moving average. It's very volatile above it and doesn't look like we'll be testing it anytime soon just yet. Yeah, I mean, we are gonna spike higher in my opinion. This does want to go into the 30s, the volatility index. And so this red line represents the S&P 500 and it's below the current volatility. And what do we know? As soon as the volatility goes on, the Dow also drops, or the S&P 500 drops. Look, spiked up big, followed by a correction. Yeah, very interesting. So I know that the hedge fund managers are all looking at the volatility index. Daily, let's go back to the daily. Get rid of the S&P 500. Yeah, we can see a very, very clear pattern here. Yep, these are pure pennant formations, as we can see. One flag there, going up again, setting up for a second flag here. Once it breaks out above this level, we're back into the 30s, guys. So, alright, what would I do as an investor? How long has this video been going for? Okay, the video's been going for 15 minutes. Not too long. Let's just give a quick analysis. So basically the pre-market looks like it's headed to open up at 268, maybe even lower. Now here's what I'm also noticing. I'm noticing this as a potential double bottom, but now as new resistance. So you guys are all seeing this live, seeing how rubbish I am with these apps. Yep, perfect downtrend, bounced, hit the trend line. We've got a doji candle here and a clear reversal yet again. Just roughly. Maybe we can move that line a bit up. Okay, yep, so we've got the double bottom, big bounce, big drop, and as we can see, we've got these wicks that are testing, and we've closed way below. And where's the 200 moving average? Where's my little 200? Yeah guys, thanks for having patience with the video. I hope some of this is making sense. I hope you guys can see the way I think, my mindset, and maybe take a few lessons on board. Okay, so that's the 200-day moving average. We're below, it's testing the trend line, and we've closed not only below a downsloping 200-day moving average, but we've got increased selling volume. There was a study by, I think, Morgan Stanley, and they were saying that basically institutional and professional money is not only sitting on the sidelines, but they're offloading some of their investments, while retail money, dumb money, are the ones trying to dip buy. So I wouldn't really be dip buying this, because yeah, once these levels are taken out, we don't have support for a while. Back in the 200 levels, like I was mentioning, way back down here. You know, sure, it's got these little bits of supports here and there, but they're nothing significant. If we're going to see a retracement, we are retracing back to these 200 levels, without a doubt. But let's just stay a little bit more focused. We've got an opening of 269.10. Where does that fall? What level? 269.10. Doesn't surprise me, right around the levels of this double bottom. It might, you know, test those areas again, 270. But we're going to have yet another seller, another selling day. We could possibly test these levels here, 260. If we drop 4 point something points again, it should be very interesting. Alright guys, so I hope that makes sense, a little bit of the analysis on the overall markets and my reason for having caution. Also another thing that I would want to mention is a lot of people are talking about a bounce. Okay, so let's factor in a bounce. What if we bounce again off these levels, but we go and make a new lower high? What if we bounce to 279? What if we can't even break 287? In my opinion, that would be a true confirmation that there's weakness in the overall markets and that we are very close to a recorrection. a lot of the market insiders also think that a crash is inevitable. It is going to happen. The question is when. And on that note, I'll discuss a few stocks that I'm watching for tomorrow and the reasons why I'm watching them. So IHL is being one of them. I love a first green day. This looks like it wants to go retest the highs. So IHL is on watch list. NVO is on watch list. You know, it does want to break this trend line. I'm not sure that it will, but I was watching it today and kind of disappointed. I couldn't alert some people about it. It was just too quick and got distracted by a few other things. But NVO is another one I'll be watching. RGI, to see how it handles the 50-cent level. Can it break? Can it re-break 50? I like the move. Very nice move. Another one, obviously, I'll be watching DTS. Yeah, sorry guys, I just had a phone call coming in. So yeah, DTS is another one I'll be watching. I'd like to see a pullback around the 25-cent levels. Another stock that I'll be watching. So we've got IHL, NVO, DTS, RGI. Some of these biotechs have also been doing well. This could also push further up. I don't know, 5.5. Maybe 6 cents, but it does need a catalyst as well. BIT, what's happening with BIT? Nothing much. It does look like it wants to go back to 10 cents. I won't lie, guys. But who knows? Anything could happen. I don't like this action. There's clear resistance in the 30-cent levels, and BIT is the market leader with the biotech. So if this tumbles, I guarantee the rest of these will also tumble, just like that. So what else do I like? Oh, also SMX, another one that I like. That also put on another first green day. We could test the highs. Chances are it will gap up in the morning and probably respike into the 70s. What else do I like? I think these are the main ones that I'm looking at the moment. You know, I'm always scanning the markets for a couple of movers. I've got 3 or 4 watch lists that I use. I'm always scanning, you know, what's moving, what's not moving. Yeah, so as you can see, DTS, SMX, AMP, BGL. These guys are going to push into the 50s. BGL, first green day, breakout. You could wait for a pullback, see how close it gets to this level, 41, 42 cent levels. If it manages to hold, it could be a confirmed breakout and push into the 50s. Yeah. Interesting. This is a clear pump. When a stock is going straight up, it's being pumped on the inside. But yeah, this does need to get pulled back to 30. Oh no, wait, the raise was at 34.5, wasn't it? But who knows? Alright guys, that's my video. It's a wrap. Let's just see how the markets open tomorrow. Thank you for watching. If this video makes sense, if you guys have any comments, feel free to jot some information down, hit me up, and yeah, I'll catch you guys soon. Ciao.